What's the most important cloud for the markets right now?
Well, what the market thinks is the most important is the possibility of a recession. It was the market believes that the bond market is omnipotent and can see the future, and the bond market is telling us we're going to have a recession. And I just don't believe that bond investors have that kind of foresight. We heard this in the fourth quarter about how we were going to have an inverted yield curve and that was going to bring us a recession, and yet we've had very solid economic growth since. So the market is very skittish about signs of a recession. People remember 2008 as if it was yesterday. They don't want to be long stocks if we're going into a recession.
Right. Everything feels like it's going to be 2008 redux, that's the only possible game plan right now. I know you've been bullish on some of the financials. Charlie, are you sticking with those calls?
I am. I'm Goldman Sachs at less than book. I think it's at 0.9 times book. One of the few almost absolute trading rules is if you can buy a high-quality investment bank at less than book, it's going to work out for you, and that's what we feel right now. We got a lot of high-quality banks like Bank of Oklahoma trading at 11 times earnings. Those are cheap. What's not cheap right now are consumer staples, the safety trades, the bond substitutes. Those are expensive, trading at 23, 24 times earnings.
Right, but Jim, those probably look like a bargain compared with where bond yields are right now. I mean, what are investors who are looking for income supposed to do?
Not get it, because bond yields will continue to fall, although there has been a great capital gain on the bond market, especially with negative rates in Europe. I mean,
absolutely.
You know, some of those bonds are up 50 or 60% this year. It's been just spectacular. But I would say, though, that, you know, pushing back a little bit on what Charlie said, what the bond market sees is global slowing. It is always traded off of global growth. Europe is such a basket case right now. You can almost say it's already in recession. We're just arguing how big a recession it is. Japan, they've already got negative quarters of GDP forecasted for Q3, Q4. China had the worst industrial production numbers in 17 years. That means worse than the financial crisis. That is what's dragging the world growth down. That's what's dragging yields, not only in the United States, but around the world. All yields are somewhat related to each other, and they're going to keep falling.
Jim, probably the most important question is, can the U.S. avoid a recession with all of this? And it means, are the bond yields and the yield curve telling us something different this time? Because with every passing year, the global economy is a bigger contribution to global GDP.
Right. And one thing about the yield curve, a bunch of stock guys decided that the 2-year, 10-year yield curve was more important because it didn't invert. The yield curve that all the studies have been done on is the 3-month, 10-year curve. That inverted in May, and it's deeply inverted right now. That is a big worrisome sign. Can we avoid recession? Sure. If the Fed got aggressive, cut rates aggressively, and uninverted the yield curve, you might have a chance at getting some stimulus. But if they want to go 25 in mumble mid-cycle, they're going to make this worse. That's what they've done since July 31st.
All right, Lauren, we have Jackson Hole coming up, a chance for the Fed to maybe get out there and explain what its message really is. One of our guests this week said it should be Powell's whatever it takes moment, like Mario Draghi had, 7 years ago now, maybe. What is your advice in terms of where people should be in the market right now with all of this going on?
We're not calling for recession, much like our other guests have said, but we do think it's time to move more defensively in portfolios. We're doing the same thing.
Despite the value, so when you say more defensively, you're talking about also some of the most overvalued parts of the market.
Yes, and valuations are fragile. So when it comes to where to play defensively, it's where can you find add value in your portfolio without relying on price appreciation. Now, that said, there are dividend yield traps, there are value traps, and so what we're looking for are, in the equity space, for example, are securities that provide low volatility, consistent revenues, because 2/3 of companies always beat earnings. It's all about revenues where that's concerned. And in the fixed income space, there's lots of opportunity for diversification. We like municipals, for example, that provide good diversification, low default probabilities, and infrastructure, for example.
Yeah, I know I hear people talking up munis. I hear, are there any specific names in the stock market you can recommend, or I don't want to put you on the spot if that's not.
Well, I can't talk in terms of specific names, but we can speak in terms of themes. One of the things that we see as the most prominent risk to valuations right now is policy risk. That's not just trade wars, but also where the Fed is concerned. And so when it comes to really interesting ideas, we actually think that the U.S. is where some of the best opportunities are.
Okay.
We're starting to move underweight international developed and emerging markets because of some of the valuation risks we've seen.